What is the point of creating new content when it is already available on the IRS website? My aim is to interpret IRS laws in a story format for a comprehensive comprehension to steer clear from confusion. My today's topic is about contributing to a pre-tax retirement account is one of the various ways to defer taxes. I'm going to share with you shortly a few strategies which a taxpayer may consider when expecting capital gains on selling a property. I'm also going to share it with. I'm also going to explain it for a better comprehension with a case study. This is Nashima, the CEO of InfoTaxQuire.com. We are a team of CPAs and EAs. Greetings to those who are connected with my channel and greetings to those who have been using InfoTaxQuire.com for their business needs for years and years. I request attorneys, tax preparers, taxpayers, entrepreneurs, student economists, and the most important politicians who create laws to subscribe to my channel to receive the most up-to-date and accurate tax information to enhance their knowledge. What are the strategies a taxpayer may contemplate when planning to avoid paying taxes on capital gains when selling a property? Number one, a taxpayer can offset taxes up to $250,000 if single or $500,000 if married filing jointly on a primary residence if the taxpayer has lived 2 years out of 5 years prior to sale. Number two, a taxpayer can use capital losses against capital gains to reduce taxable income and tax bills. A taxpayer can consider installment sales to spread out the gains over many future years rather than receiving a lump sum amount on sale and paying taxes. Number four, to defer capital gains taxes and exclude some of the gains, taxpayers can reinvest their profits into qualified opportunity zones. Number five, by donating a portion of the proceeding, by donating a portion of the proceeds to charity, taxpayers can earn tax deductions and lower their taxable income. Ensure that all selling expenses such as real estate fees, legal fees, and advertising costs are deducted from the sale price to lower the taxable income. And taxpayer can also consider contributing to retirement trust to defer to lower taxes. Let me summarize that again. If you are single, you can deduct up to $250,000, and if you are married filing jointly, you can deduct up to $500,000 to reduce your taxes. If you are selling a property which has been your primary residence 2 years out of 5 years, you also have an option. If you have losses, you can offset those. You can utilize those gains. You can utilize those losses against your capital gains which you are expecting to lower your tax liability. There is also an option available for installment sale. Rather than receiving lump sum amount and pay a high taxes, you can also spread it out over many years so that you can pay lower taxes. You can also reinvest your investment in a qualified opportunity zone, and you also have an option to donate your property rather than selling it. And if it is a long-term property, you can take the fair market value for the deduction. And you can also claim all the expenses such as legal fees, advertising fees, agent fees, and the other fees which are subject to deductible can lower your taxable gains. And finally, taxpayer can also consider contributing retirement plans. You can also invest in retirement plans such as IRA, 401k, IRA, traditional IRA, Roth IRA, 401k. You may consider it. Now I'm going to share with you a case study to comprehend. Zoe, who is 45 years old, is selling a condo she has owned for 15 years for a significant profit before moving to a new job. The condo has never been her main home or residence. A 25% pay increase is included in Zoe's new job. Zoe does not have any other investment. So Zoe is moving somewhere else, and because she is expecting a better salary, and she owns a home, but she never lived there, and therefore she cannot take the deduction of $250,000. Therefore, as per my advice, Zoe is limited in her options. To easily reduce her taxable income, particularly with a significant pay increase, she could contribute to a pre-tax retirement account. Zoe can contribute for 2024, which is limited to $7,000 annually, with a traditional IRA. Traditional IRA are account where individuals contribute before income tax, and the investment in them grow tax deferred. Zoe may able to contribute up to $23,000 in pre-tax dollar in 2025 if her new employer offers any retirement account incentive like 401k. Again, so the whole story for this program was how can a taxpayer defer or save taxes. So contributing to a pre-tax retirement account is one of the various ways to defer taxes. So Zoe can consider investing her money into a retirement fund. And my advice for Zoe is she can consider $7,000 annually in traditional IRA, or if her employer is contributing, so Zoe may be able to contribute up to $23,000 in pre-tax dollars in 2025 if her new employer offers any retirement account incentives like a 401k. Thank you and God bless you.